Welcome to the Deep Dive, where we cut through the noise of your research and get straight to the insights. Today, we are digging into the recent Q3 fiscal year 2025 earnings call for RH.
We are, and the goal here is to really understand the numbers, but also the strategic story that completely captivated the market.
It really did, because the market's reaction is the entire story here. You have to walk away understanding why investors looked at a pretty significant earnings miss and, well, just decided to ignore it.
They chose to focus entirely on the horizon. It's a fascinating case study.
Okay, so let's set the stage with this mixed print, because it's a perfect example of conflicting signals. On the one hand, the top line looked pretty solid.
Yeah, revenue came in at about $884 million. That's up almost 9% year over year.
So it's slight beat against what Wall Street was expecting. Good sales performance, on the surface.
But the bottom line was the friction point. Adjusted diluted EPS was $1.71.
Which was a huge miss. Consensus was looking for $2.13. That's a 42-cent shortfall. In this market, for a luxury company, that should have been a disaster.
It absolutely should have sent investors running, and yet the stock closed sharply higher the next day.
And that move tells you everything you need to know, doesn't it? The market just completely prioritized management's long-term story over the quarterly margin pressure. They bought the 2026 story, not the Q3 results.
Exactly. And to get that story, you have to understand the margin erosion they called out. It was real. Gross margin came in at 44.1%.
Down about 40 basis points year over year.
And more painfully, the adjusted operating margin was 11.6%. That's well below their own guidance midpoint of 12.5.
Almost a full percentage point miss. So if the market believes this pain is temporary, what were the specific culprits? What dragged it down?
Management pointed to two main things, both of which they framed as temporary. First was higher than expected tariff expense leakage.
Okay, so this wasn't new tariffs, but old costs finally hitting the books.
Pretty much. It's costs on special orders and back orders from prior periods that were just delivered in Q3, so it's a messy timing issue. The second thing was, well, an intentional cost.
The Paris opening.
Higher expenses associated with that big ramp up, that's an investment, not a recurring operational flaw.
Right, which all feeds directly into their broader macro thesis. They're basically saying the entire industry environment is terrible, but they're still winning.
They are being very defensive, but they are backing it up. They called it the worst housing market in almost 50 years. The argument is that in a historically depressed market, their 9% revenue growth is actually a sign of massive market share gains.
Wait, but is that just a bit of a defensive crouch? I mean, 9% growth is good, but is it possible their high-end customers just more insulated from all this?
It's probably both, but they gave some really powerful context. They pointed out that the U.S. is on track to average about 4 million existing home sales a year between 2023 and 2025. That volume is almost identical to the sales volume from 1978.
Wow.
When the U.S. population was 53% smaller. So the context is that the overall environment for home goods has, rarely been tougher.
And on top of that demand side pressure, you've got the supply side chaos with tariffs.
Absolutely. They mentioned 16 different tariff announcements in the last 10 months alone. It creates constant delays and forces endless price negotiations. It's just a continuous drag.
So it sounds chaotic. But through all that, the balance sheet actually showed some incredible discipline.
This is where the long-term story gets its credibility. They generated $83 million in free cash flow in Q3.
Which keeps them right on track for their full-year guidance of $250 to $300 million. That's real cash generation.
And that cash gives them options. They used it to reduce net debt by $85 million in the quarter.
And here's the part I found most impressive. Inventory.
A huge reduction. Down 11% year over year. They cut $82 million in inventory from just the prior quarter.
To do that while you're opening massive international galleries and planning a product launch, that's just a sign of a very tight operation.
It is. They're de-risking the finances while ramping up the strategic ambition. It's why the market is willing to look past the EPS miss.
So let's talk about that ambition. Strategic pillar 1, building the global platform.
And Paris is the key here. But it's positioned as something very different than just a new store.
Right. They call it a brand amplifier. It's not about selling chairs in France. It's about establishing global authority and showing they're a luxury design platform.
And we get some great color on this. The rooftop restaurant there, Le Petit, was apparently the highest grossing operation per seat when it was open.
They hadn't even fully anticipated the demand, right?
No, it was so strong they had to do unexpected retrofits just to handle the volume.
And they're learning how to communicate the brand. They added an architecture and design library in the entrance of the Paris gallery.
With that incredible inscription.
In Paris, the measure is eternity. This we know and have built accordingly. I mean, that's not your typical retail mission statement.
No, it's selling permanence. And it's working. They said they're already getting huge design jobs from places like Morocco and the Middle East, all sparked by the Paris opening.
Which brings us to their other revenue streams, hospitality and interior design. Let's start with the hospitality economics.
They're phenomenal. They talked about the Ocean Grill in Newport Beach. That one restaurant is on a path to do over $20 million a year in revenue.
And the cash flow from that one restaurant is projected to cover the rent for the entire 90,000 square foot gallery it's attached to.
Exactly. It's a fundamental shift in real estate economics. On average, their hospitality operations already cover 65% of their rent.
It turns a cost center into a profit center that subsidizes itself. That's incredible capital efficiency.
And the design services side is maybe even more potent. They opened a standalone productless design office in Palm Desert. It's tiny, only 3,000 square feet.
And it's doing $1 million a month in design business.
Yeah.
Without selling a single sofa from that location. They're just selling the vision.
Taking on huge projects like a $3 million design job in a famous New York mansion. It proves the shift from selling products to selling entire concepts.
Which is the perfect lead-in to strategic pillar 2, the next growth engine. They dropped some major news here.
They really did. They talked about a new concept launch for 2026 that they called, and this is a quote, the most prolific product transformation in the history of our industry.
No small words there. This is their bet to re-accelerate growth.
And it targets a very specific niche, the traditional and classic aesthetic, which they believe accounts for 60% of homes valued at $5 million or more.
So they're going right for the very top of the market where they feel they have a gap.
They do. And the launch is set for spring 2026 at the Salone Show in Milan. The CEO thinks this could be a multi-billion-dollar business in 5 to 10 years.
Just this one concept.
That's just this one concept. And to anchor it, they confirmed they acquired the IP for the Michael Taylor Designs brand.
For those who don't know, Michael Taylor is basically the godfather of the California look.
Right. Classic, oversized, comfortable, architectural. It's the exact DNA they need for this new line, and the acquisition gives them instant authority.
That's a huge reveal. It ties a historical design legacy directly to their future growth plan.
Yeah.
Okay, let's wrap this up with the investor context and what they're guiding.
The CEO was asked directly if they should maybe slow down on all this investment to give the market some, short-term predictability.
And he said no.
He said a firm no. He quoted Ben Graham. In the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Their whole strategy is to build that strategic separation now while the market is tough, so they're the only one standing when it recovers.
So no slowing down,
Okay.
which is reflected in the guidance. For Q4, they're targeting revenue growth of 7 to 8%.
And an operating margin of 12.5% to 13.5%. But the key is what's baked into that number.
Yes. That margin target explicitly includes a combined negative impact of 370 basis points.
Let's translate that. That's like a third of their reported operating margin just being sacrificed right now for future growth.
It is 200 basis points from international startup costs and another 170 from tariffs. They are telling you exactly what the cost of this ambition is.
And now for our favorite part of the deep dive, the part where we get to talk about the outrageous but plausible. This is not financial advice segment.
Okay, so given this intense focus on the long game, on that weighing machine thesis, you need a tray that ignores all the short-term noise.
Management has basically anchored a multi-billion-dollar story to the spring 2026 launch of this Michael Taylor collection.
And right now, the stock is still way behind the market over the last year, down over 50% versus the S&P being up. So there's a disconnect if you buy the story.
So what's the pitch?
The pitch is to structure a long-dated, deep-in-the-money LEPS call option on RH with a maturity out in mid-2027.
Okay, so a LEPS is a long-term option. You're buying time.
You are buying a lot of time. The 2027 maturity means you are betting that by then, the market will have fully weighed the value of this new multi-billion-dollar concept.
And the cash flow from hospitality will be proven out. And maybe the housing market has even started to turn. You're wagering that all those strategic investments will be reflected in the stock price by then.
It's the ultimate weighing machine trade, a pure bet on management executing their plan.
So the core takeaway from this whole call seems pretty clear. RH is willingly taking a big margin hit right now.
A very big hit from tariffs and international expansion.
All to build out this multi-platform luxury ecosystem. They believe market share gains now, plus that huge 2026 launch, will let them re-accelerate when the housing cycle finally turns.
The current pain is temporary, but the strategic platform they're building is, they hope, permanent.
Let me leave you with a final thought then. It's based on the CEO saying necessity is the mother of invention. If RH is truly designing these new, capital-efficient business models, like a restaurant paying for an entire gallery because the environment is so tough, how many other companies are using this chaos to genuinely reinvent themselves? Or are they just waiting for things to go back to normal?
Something to think about. And as always, remember, we only summarize the information from the call and we offer absolutely no financial advice.
We'll catch you on the next deep dive.